Surely you have heard about Warren Buffett. If you are a new investor or a seasoned player in the market, at some point you may have aspired to be like him. After all, he is one of the most successful investors the world has known. And when Warren Buffett recommends something, there must be some value in it, isn't it? No, we were not talking about stock recommendations. We were talking about a book, The Intelligent Investor, penned by Benjamin Graham. In Warren Buffett's own words, it is by far the best book on investing ever written. If you have not read it yet, it may be time to get yourself a copy. But even if you have, it's never a bad idea to revisit some of these little, isn't it? So without further ado, here are 5 of the most important lessons from the intelligent investor. Understand the value of the business you are investing in. One quote from the book goes, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price. Means is that the stock you wish to invest in is not merely an asset listed on the exchange. There is an actual business behind it. And if you are a long-term investor, you need to understand how much value that business has. Market price it trades at today, or is it overvalued? Does the company's business have any potential for growth in the future? The question will help you understand how your investment could appreciate or depreciate over the long term. And if you make your investment based on this kind of evolution rather than guesswork, you could be a more successful investor. Second, make investments objectively. Be aware of why you are investing in a particular stock. Benjamin Graham drives home this point by drawing a fine line between investors and speculators. Quote his observation from the book: people who invest make people who spend for their brokers. Speculation carries a high degree of risk, and consequently the possibility and the quantity of loss are higher. Invest intelligently over the long term. You need to put your money on an asset objectively, knowing you are choosing it. Otherwise, your money will only go towards paying your brokerage, and your capital will only be eroded. Priorities is research over impulses. A great many tend to buy or sell on an impulse. If you have been guilty of this habit too, it may be time to turn things around. Focus on research and analysis. If you are investing for the short term, technical analysis is your best friend. But if you are a long term investor, you need to perform fundamental analysis of your preferred stocks. This will help you stop focusing on what your stock market game is all about. As Benjamin Graham quotes in his book, investing is not about beating others at their game. It's about controlling yourself at your own game. Steer the herd. The herd mentality is what drives an investor to buy a stock just because a lot of others are, or to sell their holdings simply because the general market is doing that. However, this is not the right way to buy or sell your holdings. As the book clearly suggests, the stock investor is neither right or wrong because with him. He is right because his facts and analysis are right. So stop herd and start focusing on facts and analysis. This will help you make informed investments decisions rather than merely selling or buying based on what the majority is doing. Fifth, the past matters, but not too much. If that shows a bit self-contradictory to you, take a look at these 2 lines from the book. Those for the past are condemned to repeat it. The heart of Graham's argument is that the intelligent investors must never forecast the future exclusively by extrapolating the past. Here is that you need to keep your past mistakes in mind so you don't in your future investments and trades. Similarly, you also need to keep track of the practices that worked in your favor. Adopt these best practices in the future. The other lesson here is that the Historical data of the market does have some relevance, but you cannot simply extrapolate it and assume the future will play out just like the past did. In other words, relying relying too much could be a costly mistake at the same time. Past data entirely and not a favorable practice. Conclusion: it is simply a preview of the wonderful pearls of wisdom that the intelligent invest within its pages. Go grab a copy of it online online if you have not, but keep in mind that you need to take advice from relevant to your investment goals and needs. And once you have understood the do's and don'ts of investing, or feel better poised to becoming an intelligent investor yourself. The only thing, open a Demat account and start investing, putting to good use everything you have learned from this book. Thanks for watching. Thanks for watching.